So as of yesterday, the Fed had just raised rates by another 25 basis points, bringing the federal funds rate to the 4.75 to 5% range, the highest it has ever been since the great financial crisis back in 2008-2009. So in this video, we'll be discussing what the Fed said, how much higher can interest rates go, and more importantly, what does this mean for the stock market, or as you all like to ask, can buy or not I'm going to answer all of that in this video, so let's jump right in. Since last year, in order to fight inflation, the Fed has been raising rates at the fastest pace ever in recent history. And many people were originally expecting the Fed to raise rates by 50 basis points this time round. But then, all this fast and furious rate increase started causing some unintended side effects, like banks collapsing here, banks collapsing there, banks collapsing everywhere. Okay, it's not that dramatic, but you get the idea. After this happened, many people like Moody and Bill Ackman thought that the Fed would not continue to raise rates. Elon Musk even went as far as suggesting that the Fed should cut rates by at least 50 basis points. Then, when the Fed finally announced the 25 basis point hike, all of them had a shocked Pikachu face. That's because the Fed has said time and time again that they will keep raising rates until the job is done. Basically, the Fed be like, stop your head. But to understand why the Fed is so determined to keep raising rates, we will have to look at the inflation report that came out last week. First up, food inflation has been consistently trending downwards since last year. Even egg prices, which previously shot to all-time high, are now starting to come down. Energy inflation has been consistently trending downwards too, as oil prices and natural gas prices are now coming down. New vehicle inflation has came down, same for used car prices. The only main thing that's still going up strongly is shelter, which is basically stuff like rents and mortgages, and it makes up about 1/3 of the CPI, so it's quite significant. But the good news is that shelter inflation is a lagging indicator, which lasts around 6 to 12 months. That's because people aren't buying a new house or renting every other day. So the data that we see today are the deals and leases that were signed a few months ago. And sure enough, there are reports that show that rent prices have been falling. Same for home prices, which saw its biggest 6 months drop since 2008. So within a few months' time, all this new data will be reflected in the CPI report. Take note, I'm talking about the US, not Singapore. In Singapore, home and rent prices have been going up, like whee! So if everything is already starting to come down, why hasn't the Fed pivoted yet, but instead continued to raise rates? The answer is simple, because the inflation is still super high. The last time it was this high was almost 40 years ago, where dinosaurs and monsters still roamed the earth and Power Rangers had to defeat them before they destroyed the world. Just kidding, I just wanted to make sure that you are still paying attention. But where do we go from here? BlackRock thinks that the Fed could raise rates all the way to 6%, while the market thinks that there won't be any more rate hikes, and instead predicts that the Fed will cut rates, bringing the rates all the way down to 4 to 4.25% range by December. Then the Fed be like, you all don't anyhow say can or not, and say that rate cuts are not in their base case. So what's their plan? Check this out. In their latest projection, they predicted that the rate could increase up to 5.1% in 2023. There's no change as compared to the previous prediction back in December. This was a totally different stance in March, where they wanted to raise rates even faster. But now, with inflation coming down as expected and the whole banking crisis going on, the Fed feels that they can't raise rates as fast as before. And if it all goes according to plan, there will be just one last rate hike in May, bringing the final rate to 5.1%. Quick pause. One of the many things that I like about Webull is that they make it super easy to analyze the stock. At the stock analysis tab, I can see useful stuff like analyst ratings, price targets, and quant ratings. Further down, it even provides you with daily and weekly technical analysis that can help you to decide when is a good time to buy. And due to popular demand, Webull has further extended their flash deal. By just funding any amount and maintaining the funds for 30 days, you will get 5 free stocks worth up to $500 US. This promotion lasts till 31st March 4 PM Singapore time. So if you still have not signed up to Webull yet, you can quickly sign up using my link down below before it ends. With that being said, let's get back to the video. Besides that, they also revised their projections from change in real GDP to 0.4%, down from the previous 0.5%. Same for 2024 projections, which dropped from 1.6% to 1.2%. Meanwhile, unemployment rate projections barely changed, which signals that the economy is still strong, though the Fed expects inflation to slightly go up this year from the original 3.1% to 3.3%. So, in short, nothing much has changed since the last projection, and everything is business as usual. And that brings us to the most important question. So, what happens to the stock market now? To start, let's first talk about the Fed's balance sheet, which looks like they have started printing money all over again, just like the good old days. Some people are saying this is not QE, or others are saying this is QE, and that a bigger Fed's balance sheet equals stock market to the moon. So, let me explain what's going on. This $300 billion jump in the Fed's balance sheet was caused by three things. One, banks borrowed $153 billion from the Fed via something called the discount window. So, instead of the banks borrowing money from one another, they are now borrowing from the Fed. This discount window is not a new thing, and it has spiked before in periods of crisis, like in 2008 and 2020. Two, there was also the newly created Bank Term Funding Program, where banks borrowed $11.9 billion to increase their liquidity. Third, around $143 billion were lent out to banks that collapsed, like Silicon Valley Bank and Signature Bank, so that people can continue withdrawing money from them. So it's just the Fed lending money to the banks, and there's no new money created. All these are just short-term loans. They will need to be returned back to the Fed. For the discount window, it's a 90-day loan. For the Bank Term Funding Program, it's a 1-year loan. And for the SVB and Signature Bank, FDIC will recover money from the banks and return it back to the Fed. And once the Fed gets back the money, their balance sheet will shrink back down. This is a totally different thing from the QE back in 2020, where the Fed was buying treasuries and mortgage-backed securities to do their so-called money printing. So in short, it's not QE and don't have the effect of QE. Though, as someone on Twitter puts it, we have to see what the banks do with all the extra money. If they go and use it for investments or spend it, there will be more liquidity in the economy and may have the same effects as QE. So what does all this mean for the market? Short answer, no one knows. Long answer, no one knows. Back in December, Bloomberg found that the spread between the best case and worst case predictions was very wide. Check this out. Okay, we can ignore Credit Suisse here, because they're already having trouble predicting their own fate. So don't even talk about predicting the market. But some analysts feel that the S&P 500 could crash to $3,675, while others think that it can go all the way up to $4,005, about 14% from the current price. So again, no one knows. But we could still make a fun prediction, right? So here's what I think. 1. Historically, the market tends to bottom during rate hike cycles. 2. The S&P 500 has seldom gave consecutive years of negative returns in the past. 3. Bear markets typically only last about 1 year. So if history were to play out again, it seems like the market has a good chance of going up this year. Though I don't think it will be rocket to the moon kind of going up, as stocks don't traditionally do too well in a high interest rate environment. But what do you think? Do you think the market will crash further or will start going back up? Do comment down below and let me know. Or if you have any questions, you can also join my fast-growing Telegram group to ask me and the members any questions that you may have. Anyway, that's all for this video. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.